you run at Citadel a $30-odd billion hedge fund, and you also operate the world's largest market maker, and that gives you access to unique sets of data and analytical insights. So I want to know, what is your intel and what is your gut telling you about the state of the world right now?
That's a great question. So the state of the world right now, there's been two big debates. Are we heading into recession? And what's the trajectory of inflation? And of course, the two are intertwined. I think we've been a little bit out of consensus. We have felt that we would not have a recession this year in 2022. And in North America, that's borne out to be true. We're highly confident we're going to finish this year on a modest growth note. Now, the issue, of course, is 2023, when the lagged effects of the Fed having increased rates will really start to grind on the economy. My team, for choice, thinks 2023, we avoid a recession. I'm a little more skeptical about that. I think that for the Fed to truly conquer inflation here, we're going to put unemployment somewhere with a mid-4 handle, and I find it hard to believe we're not going to have a recession at that point in time, sometime in the middle to back half of 2023. So a little bit of internal debate, and frankly, what makes Citadel so special is we have these debates endlessly, and it pushes all of us to think more critically about our perspectives, our views, and of course, ultimately the investment decisions that we make. On inflation, we think we've seen peak inflation. Now, owner's equivalent rent, which is a big driver of inflation, because of the way it's calculated and estimated, we'll see that continue to show inflationary pressure for the next few months. But spot rental rates appear to have peaked in many metropolitan areas a few weeks ago. So we think that one of the biggest drivers of consumer prices, which is rent, has reached a near-term peak. And then energy prices are likely to roll over in 2023 as compared to their 12-month prior. So two of your really big drivers of inflation, energy, rent, we think we've seen a peak in. And then across goods, we think this is going to be a really good holiday season for consumers because American companies have built up such a substantial inventory of goods that they're going to need to sell here heading into the holidays. So we think we're going to see pretty good pricing for consumers as goods become very attractively priced to move them out of warehouses. Now, why is that? Obviously, in the pandemic, you couldn't enjoy services. You couldn't take a vacation. You weren't getting a massage. You weren't going to dinner with friends. So you bought a lot of goods. I mean, I can't imagine how many flat-screen TVs were sold to Americans in the pandemic that are, frankly, not used nearly as much today as they were a year ago. So this shift from a goods-based economy to a service-based economy is going to create this depreciation in pricing of goods, which of course will help bring inflation down. So we think the inflationary path has peaked. We think by the end of 2023, our central view is inflation will be back to roughly a low to mid twos range, which is a dramatic change from where we are today.
Some Fed officials, and of course it's so important to talk about the Federal Reserve, it sets the risk-free rate for the rest of the world, and of course has created unbelievable complications with the strength of the dollar for emerging markets. Some Fed officials can say the time has already come to back off. I could cite Charles Evans. I could cite Lael Brainerd, who didn't say it's time now, but it will be time soon. Are we there yet?
It's sort of like saying you go to your doctor, you've got a bacterial infection, and he gives you 10 pills to take, and you stop taking them after pill number 7. And then you relapse a few days later. Like, it's not yet time for us to change course on our monetary policy. We want to see that we put the inflation genie back in the bottle. We've endured a ton of pain in getting to this point. The housing market is definitely under duress. Durable goods sales are under duress. High-ticket items are just out of reach of consumers today, but we haven't gotten the job done. And to take the foot off the brake right now and not finish the job, I think is the absolute worst mistake the Fed could possibly make.
Why? What happens if they, again, back off too early? If you take only 7 pills instead of 10, what are the consequences for the U.S. economy and for the global economy furthermore?
So the biggest concern is you on-anchor inflation expectations. So right now, the American public believes, and not as much as we'd like, but the American public believes the Fed's going to get the job done. If we take the foot off the brake, we don't finish the course of antibiotics, and inflation starts to flare back up, the Fed will have lost credibility. If the Fed loses credibility and inflation expectations on anchor, then the amount by which we'll need to raise rates and deter economic growth will be a much bigger bill to pay. And we shouldn't put ourselves in a position to pay that bill. We should get the job done now.